Welcome back to Factful Finance, where we break down complex financial topics into actionable advice. Did you know that many investors unknowingly make costly mistakes with their SDIRAs, self-directed individual retirement accounts? It's an unfortunate reality, but with the right knowledge, you can steer clear of those pitfalls and optimize your retirement savings strategy. Let's dive into how to avoid these mistakes. First, a quick disclaimer. The content here is for educational purposes only. Please consult with a professional for personalized advice. Now, let's explore the top SDIRA rules and common mistakes, starting with the basics. A self-directed IRA offers unique opportunities to invest in a wide range of assets, from real estate to precious metals, and even private equity. But this freedom comes with a set of strict rules. Failing to understand these can be expensive. So let's walk through some key points. The most critical rule to grasp: SDIRAs must comply with IRS guidelines. You cannot mix personal assets with IRA assets. This might seem obvious, but many investors get tripped up here. For example, let's say you use your SDIRA to purchase a vacation home. While that may sound like a great idea, if you or any family member uses the property for personal reasons, it's considered a prohibited transaction. This violation can lead to severe penalties, including disqualification of your IRA. Another common pitfall is overlooking the custodian role. SDIRAs require a custodian to manage the account, but this doesn't mean you can just pick any provider. You need one that is knowledgeable about the specific assets you're investing in. A custodian unfamiliar with non-traditional assets could lead to costly mistakes in transaction processing or compliance issues. Let's consider the example of Ben, a real estate investor. Ben chose to invest his SDIRA in rental properties. While everything seemed to be going smoothly, he didn't check if his custodian could handle real estate transactions. As a result, he missed a few critical deadlines for reporting income and expenses, triggering a penalty. Make sure your custodian is well-versed in managing the kinds of assets you want to invest in. Next, let's talk about Unrelated Business Taxable Income, or UBTI. This applies to investments like partnerships or certain businesses inside your SDIRA. If the business generates UBTI, the IRA is taxed on that income. Many investors are unaware of UBTI until it's too late, and the tax consequences can be significant. Sarah learned this the hard way. She invested in an LLC through her SDIRA, but the business started generating UBTI without her knowing. When the IRS came knocking for taxes, Sarah had to dig into her pocket to cover the cost. Remember, UBTI doesn't just apply to businesses you own directly. It can also affect certain types of income generated within your SDIRA. Always do your due diligence and consult with an expert to understand any potential UBTI implications. Another potential mistake comes from not adhering to the IRS's prohibited transaction rules. Aside from personal use of assets, the IRS also prohibits certain relationships between the IRA holder and the investments. For instance, you cannot use your SDIRA to invest in companies where you or a family member have a significant financial interest. This could easily slip under the radar if you're not careful, so be sure to check that your transactions follow the rules. Let's pause here for a moment. What's your biggest concern about SDIRAs? Do you have any experiences you'd like to share about managing one? Drop a comment below and let's keep the conversation going. Now, let's talk about fees. SDIRAs come with some unique fees compared to traditional IRAs. You may face setup fees, transaction fees, and even annual maintenance fees that can eat into your investment returns if you're not prepared for them. Make sure you have a clear understanding of the fee structure before opening an SDIRA to ensure it aligns with your financial goals. To wrap things up, one last critical point: RMDs, or required minimum distributions. When you reach the age of 73, you'll need to start taking distributions from your SDIRA, unless it's a Roth SDIRA. Failing to take these distributions on time will result in a 50% penalty on the amount you should have withdrawn. So, stay ahead of the game and ensure you're tracking your RMDs as you approach retirement. In conclusion, SDIRAs offer tremendous flexibility, but they come with serious responsibilities. The key to avoiding costly mistakes is knowledge and preparation. Always choose a knowledgeable custodian, understand the IRS rules, and be mindful of potential pitfalls like UBTI and prohibited transactions. And if you're unsure about anything, seek expert advice to protect your retirement savings. If you found this video helpful, why not subscribe so you don't miss out on more valuable insights? And don't forget to hit the bell icon to stay updated. We think you'll also find our video on top investment strategies for retirement interesting. Check it out next for more expert advice. Thanks for watching, and we'll see you in the next video.